All right, today we're jumping in to take a look at one of the wildest stocks out there right now, YHGJ. Seriously, its recent performance isn't just a simple climb. It's a gut-wrenching, absolutely thrilling, and maybe even a little bit terrifying roller coaster. So you know what? Let's just strap in and see if we can decode this wild ride together.
To get a feel for just how intense this ride is, let's start with this one number, 112%. Think about that. In less than 2 months from its low point in late August to its peak on October 10th, the stock just exploded. A jump like that? That's exactly why we need to try and make some sense of all this madness.
But here's the thing. It wasn't a straight shot up at all. The journey was, well, it was chaotic. You had a massive surge in July, then a complete and total collapse down to under $5, and then this absolutely parabolic recovery right back to its highs. This isn't just volatility, folks. This is extreme, erratic behavior.
So let's get into it. We're going to start by breaking down the extreme forces that are pushing and pulling the stock in, well, pretty much every direction. You know, every roller coaster needs an engine, right? And for a stock, that engine is powered by trading volume. Price tells us where the car is on the track, sure, but volume tells us how much fuel is actually being burned to get it there. And you can see that connection crystal clear right here. The biggest price jumps, they happen on days with these enormous spikes in volume. Just look at October 10th, over 6 billion shares traded. That's not just fuel, that's a rocket launch. Analysts call this a liquidity event, which is basically a fancy way of saying it looks like some major institutional money just poured into the stock.
Okay, so if we're on a roller coaster, we're going to need a dashboard. And that's exactly what technical indicators are. They give us real-time signals about speed, about momentum, and about potential danger just around the corner.
So first up is the RSI, or the Relative Strength Index. The easiest way to think about this is like the roller coaster's tachometer. It's not measuring the price itself, but the speed and intensity of the price changes. Basically, it helps us see if the engine is being pushed way too hard and running way too hot. And YHGJ's tachometer? Oh, it is deep in the red. At 76.09, it's way above the 70 level that signals an overbought condition. To put it simply, the engine is running dangerously hot. It might be due for a cool down or, a pretty sharp correction.
Next up is the MACD. This is our momentum gauge. It looks at different price averages to tell us not just if the stock is going up, but if that upward momentum itself is getting stronger or weaker. Is it accelerating up the hill, or is it starting to run out of steam?
And the MACD reading here is a positive 0.2578, and it's growing. So what that's telling us is that the roller coaster isn't just climbing, its upward momentum is actually getting stronger. It's literally accelerating on its way up the hill.
And finally, we've got the CCI. Think of this one as an extreme velocity alert. It measures how far the current price has strayed from its historical average. It's designed to tell us when the ride has gone so far off its normal track that a snap back to reality is, well, it's highly probable. And this reading is just extraordinary. 435.30. I mean, just for some context, any reading over 100 is already considered extreme. This number is screaming that the current price path is so far outside its normal behavior that it's probably just not sustainable.
So, with all these warning lights flashing on the dashboard, you might think, okay, let me just look at a map for guidance. But what happens when the traditional prediction models, the maps we usually use, are completely useless for the terrain you're actually in?
And here is that problem in a nutshell. A standard linear regression model, a really typical predictive tool, said the price should be somewhere around $5.36. The reality? It was $9.32. That's a 73% miss. And the reason is that these models rely on past data, but when a stock is in a pure momentum phase, driven by hype and speculation, the past kind of becomes irrelevant. The model wasn't just wrong, it was completely and utterly lost.
And this quote from the analysis just sums it up perfectly. The stock isn't moving based on old averages or nice, neat, linear trends. Nope, it's in a pure momentum phase, and it's playing by a completely different set of rules.
So if the old maps are useless, how in the world do we anticipate what's coming next? Well, we look at the track itself, at the key support and resistance levels that are acting like guardrails for this whole ride. These are the guardrails. You've got resistance up at 10.29 cents. That's the ceiling the stack has hit before and really struggled to break through. Then you have support, down around $7. That's the floor where buyers have jumped in before to stop it from falling any further. The next big move, it's probably going to test one of these two boundaries.
So what could happen? Okay, scenario 1 is the bullish climb. All that rocket fuel from the massive volume keeps burning. The ride smashes right through that 1029 ceiling and it heads for new highs, maybe somewhere in the $11 to $12 range.
Then you've got scenario 2, the bearish drop. This is where all those dashboard warnings come true. The engine overheats, traders decide to take their profits, and well, gravity takes over. The price could fall pretty quickly back to that $7 to $8 support floor, or maybe even lower.
And finally, there's the sideways coast. The roller coaster doesn't climb or drop, it just kind of levels out for a while. This would let the engine cool down, it would allow those extreme indicators on our dashboard to reset, and it would give the market a chance to just catch its breath before the next big move.
So, after all that, what is the takeaway from a ride this wild? It really all comes down to a single, crucial conflict, weighing the potential thrill against the very, very real risk of a spill.
Here it is, the core tension laid bare. On one hand, you have a truly historic breakout, and it confirms powerful momentum and huge market interest. But on the other hand, you have basically every technical warning light flashing bright red, screaming that the stock is overbought, overextended, and at a really high risk of a sharp correction.
And that brings us to the final question. We've explained the forces at play, we've shown you the dashboard, and we've mapped out the potential paths ahead. But ultimately, when you're standing in front of a ride this extreme, you're the only one who can decide. Is the potential thrill worth the undeniable risk?